Right, well, welcome to the latest in our Finance for Expats webinar series. Today we're covering financial planning for British expats living in the US. I'm Nigel Ayres, I run Expat Network, and I've been an expat for big chunks of my life in Hong Kong, Malaysia, and twice in California. So this one's familiar territory to a certain extent, having lived and worked in America. So today's webinar will be presented by Mark James, Principal Advisor, US-UK Cross-Border Services at Alexander Beard. Mark will take you through key financial planning issues faced by British expats in the US. He will look at the options for handling your UK private pension and consequences of a wrong decision. He'll also look at the implications of FATCA, FATCA, for Brits in the US who left behind ISAs, investment bonds, endowment policies, etc. We'll also look at efficient options for Brits leaving the US to deal with their IRA accounts. So just before we start, perhaps it's worth saying that if you have any questions, please use the button on your screen. We'll answer those at the end of Mark's presentation, and any that we're unable to cover, we'll answer by email after the webinar. And if you're watching the recording, then also, please send it in to us by email, and you can contact us at expats@expatnetwork.com. Okay, well, thank you. Now, Mark, over to you if you'd like to take it away. Thank you.
Thank you very much, Nigel. Well, I just want to say welcome, everybody, and thank you for joining this presentation. First of all, I'd like to tell you a little bit about who we are. I know Nigel's just kindly introduced us. Alexander Beard have been providing international financial advice for over 30 years now. We've got offices all over the world, including our US office, which is based in San Francisco, just outside San Francisco, actually. We are registered and regulated in both the USA and the United Kingdom, as well as other jurisdictions for different offices. But obviously, for the purposes of this presentation, for you British expats in the US, we are regulated by the Securities and Exchange Commission in the United States and by the Financial Conduct Authority in the United Kingdom. There aren't many firms that have this, registered and regulated in both jurisdictions. There are some, but not many. Me personally, I've been in financial services industry for about 27 years now, and I don't think that old, but apparently I am. I started working in the investment banking world, moved into international banking before I became an international financial advisor, which I find fascinating. As well as the firm, I'm also individually registered in the US and the United Kingdom. And I'm also a qualified investment manager and a pension specialist. So without further ado, I will share my screen with you guys. So we can get started. I assume that everybody can see this. Okay. So as you can see from the slide, the presentation is intended and it's going to be useful for individuals who have worked in the United States or you reside there, but you're originally from a different country. So you're born in a different country, but you may well have assets in both jurisdictions, your country of birth and the United States. Also, the presentation hopefully will be useful for British expats that return to the UK, because I have many clients that have actually done this. A lot of them think that I'm going to be spending the rest of my life in the United States, and after 20 or 30 years or so, they happen to find themselves going back to the United Kingdom, and then they have assets in two different jurisdictions, and then all sorts of different complications can arise. So, without further ado, if you've answered yes, i.e. you're a British expat in the USA, or a British expat that's planning to return to the UK, I think this will be very useful for you. So first of all, I'm going to start with a piece of legislation called FATCA, as you can see from the slide. FATCA stands for the Foreign Account Tax Compliance Act, and it was part of the Hire Act, and it's commonly known as FATCA. This piece of legislation was all about, effectively, the United States were sort of fed up with US citizens or US connected persons, as they call it, living abroad, and they weren't sort of declaring their assets and they were sort of not avoiding tax, but the IRS was losing out on huge revenues. It's been incredibly successful, but it's been a headache for a lot of countries around the world. But many of them signed it. In the United Kingdom, it was signed and became law in 2015. FATCA basically means that all financial institutions, foreign financial institutions, if you are a US connected person, i.e. US citizen and or green card holder, or a dual US-UK person, and you have assets in the UK, then the financial institutions have a regulatory requirement by law to report your assets to the IRS, whether you like it or not. Obviously, there's certain caveats, i.e. if you have a sort of an account less than $10,000 or so on and so forth, there's certain exclusions. But effectively speaking, they will report your asset. Then you individually report your asset, your foreign asset, to the IRS, and then they reconcile it at sort of head office, if you like. So effectively, you're reporting it, Barclays Bank in London are reporting it, and then the IRS say, oh, okay, we know that this person has got a foreign asset. The actual FATCA is not necessarily, doesn't mean you're going to get taxed on it. It's more of a reporting mechanism. So the United States and the IRS can actually get data from your overseas assets. That's the point of FATCA. Not that you're going to get taxed more, or effectively, it's just all about the reporting system. That's all it was set up for. A lot of countries in Europe have signed it. Many countries around the world have signed it. I believe there's probably over 80 now. So it does affect most jurisdictions. A lot of countries are really angry with it now, to be fair, because they just didn't understand or realize how complicated this piece of legislation would be. In fact, it's got so controversial that the French government, or certain departments of the French government, have tried to sue the IRS, and they actually took them to court. They failed because they were so fed up with all this sort of reporting. So that was the concept behind FATCA, tax evasion, or well, I should say effectively just to do the reporting on it. But this legislation, as you can see, it's created all sorts of complexity. You might not even know you've got an asset overseas. You might have a savings account in Germany or England or France or wherever you may have visited or lived for a few years, and they will be reporting this asset to the IRS. So, but because there's a double tax treaty in play with most, certainly, most economies around the world, it doesn't necessarily mean you're going to pay extra tax. So that's the concept behind it. However, this is where it gets a bit tricky now. So I'll move to the next slide. As you can see, it's created many pitfalls for a lot of people. A lot of people may not even know about FATCA. You may have an account overseas, say in the United Kingdom, that you haven't even thought about reporting to the IRS, or by accident, simply by accident. It's not your fault. So there are sort of caveats where you don't have to worry and panic. There are certain exclusions that you might not have to worry about. For example, UK pensions, that's a different sort of piece of legislation, and ISAs. I'll come on to them in a bit. But generally speaking, if you've got a foreign asset, i.e. a UK asset, please just pop it down on the IRS on your tax returns. That means you're ticking the boxes, really. Now we'll move over another little piece, little known tax reform as part of FATCA that falls under that is called the PFIC rulings. That stands for, as you can see from the slide, Passive Foreign Investment Company. The PFIC rulings, basically, it means that many assets overseas are quite toxic tax-wise, because effectively the FATCA part of the legislation is, hey, report it. So the UK financial institutions are reporting it. Then once you've reported it, it's like, are you in a PFIC? A PFIC is effectively any sort of fund or investment account that it literally encompasses virtually all foreign assets. Unless you're invested in, say, US mutual funds, which is all in US investments, if it's overseas, it's highly likely that you could well have an investment that's a PFIC. Now, that's not against the rules or anything like that. It just means that you're potentially going to be paying extra tax, punitive tax costs. So to give you an idea, you could have an asset that you've made a gain on a profit on, and it can be as much as 40, maybe 50% tax, because PFIC doesn't tax capital gains. Capital gains tax in the US is around, I don't know, sort of 12 to 15%, same in the UK. So you're thinking, well, I've just made, I don't know, £50,000 profit, so I'll pay 15% of that. No. PFIC rulings come under the income tax code. So it treats all that gain as an income, as your income tax. So if you're a 35% taxpayer in the United States, the IRS will say, well, yeah, you've made 50,000, but that's not capital gain, that's a foreign asset, and it comes under the umbrella of PFIC. Therefore, we're going to tax you income tax rates. What's your income tax rate? In addition, this is the nasty little bit of it. If you've held it for many years, maybe 10 years or more, hypothetically, they will also charge you an interest rate tax, because income tax you have to pay every year. Capital gains tax you only pay once you've obviously realized the asset. Whereas with PFIC rulings, because you're supposed to pay income tax every year, what they'll do is say, well, you didn't, Joe Bloggs, you didn't pay me for those 10 years, so we're going to charge you a little bit of interest for every one of those years that you've held that asset. And therefore it can build, and before you know it, it could be potentially 40, maybe 50% tax on the gain. So again, this will affect all what's known as US connected persons. So Brits in America, even if you're a US citizen now, you will probably be a dual US/UK citizen and or green card holders. Where this may not affect you guys out there is if you're on a temporary work visa. There are sort of different rulings for that. So you come under a different sort of umbrella under the IRS codes. But as you can see, this does affect a lot of people, certainly if you've got things back home in England. So what sort of assets are we talking about? So the sort of assets we're talking about, as you can see from the slide, they really do cover the whole gambit, all sorts of weird and wonderful investments that you may have back in England. Unit trusts, funds, offshore bonds, investment portfolios, brokerage accounts, general investment accounts. Effectively, all of these come under the PFIC rulings, I'm afraid. Again, if you do have a UK asset, we can help you with all of this. We can help you to manage it. There are certain assets that you can invest in the UK. There aren't many. There's literally a handful of firms that can help you with this. We're certainly one of them, whereby you have to construct your overseas, i.e. UK investment structures in a certain way, whereby you don't fall foul of PFIC rulings. We can help with that. We've got a solution. We spent many years building it, but we do have a solution there. Also, you may have a UK property. A lot of my clients have an overseas property in the UK. Again, this can also attract tax consequences, but there's many different caveats. There's many strange sort of anomalies with it. How long did you live in it? Have you lived in it in the last X amount of years, out of sort of 2 out of the last 5 years? So therefore, you could potentially reduce the tax if you decide to sell the UK property. Again, you may just return back to the UK and keep the property and never sell it, so it won't be a problem. But a lot of people, when they move to America, a lot of my clients decide to settle in, I don't know, Florida, New York, or California, and it's like, well, I'm going to settle here. I'll sell the house. They've had the house for maybe 5 years in England. They've been renting it. Now they want to sell it. That can trigger tax consequences. Our financial expertise in these areas. We've created a lot of solutions for this sort of specific, eventuality. So moving on to, I want to cover a little bit about pensions now. This is quite complicated as well. If you have a pension overseas, i.e. in the UK, or if you return to the UK and you now have US pensions, again, this gets complicated. On with the slide. Let's just sort of explain a little bit about UK pensions, because it's quite likely that most of you on this seminar or this presentation will have one or the other. There are many different pensions in the UK. It can get really complicated, so I'm going to simplify it because it doesn't need to be complicated. If you think of it, there's 2 types of pensions in the UK. And when I say two types, there's loads of different flavors, but there's benefit, and one's defined as defined contribution. So we've got a DB and a DC. The way the best way to think about these two pensions, they work completely differently. One you can think of as a wage or a salary from the company you used to work for. And a lot of people talk about it's frozen. No UK pension is frozen. It is not frozen. It's effectively still creeping up with inflation. Even though you're abroad for the last 20 years, you might have a pension at, I don't know, BP or something from 20 years ago. It has been incrementally going up with inflation. So they're never actually frozen per se. And a defined benefit pension, technically speaking, is not invested from your point of view as the member. It's effectively a wage, it's a guaranteed income, which is bulletproof, and it's going to pay you for the rest of your life. That's all it is. You reach a certain age and it's just going to pay you a monthly income until you die. And then typically it will have a spousal benefit, typically 50% to your spouse. They will get that for the rest of their lives. And then with defined benefit pensions, or as we know them, final salary schemes, some will offer children's benefits up to the age of 23 when they finish, well, it's 18, up to 23 if they're in higher education. Then the money, the income just switches off. The children, the way that the defined benefit pension industry works, they assume, well, you know, when you come to retire, most of your kids have, you know, flown the nest, they've got their own careers, so they sort of look after the, you know, the spouse and the member. So that's what a DB is in a nutshell, guaranteed for life. There's also the reason I mentioned bulletproof is even if the company sort of defaults or becomes bankrupt, a defined benefit pension will move into under the government and the UK government through different schemes will make the payment for the rest of your life. So they are like gold dust now. 4/5 in the UK have closed. You know, a lot of new people joining the UK workforce just don't have that luxury anymore. They are highly regulated. So if you ever want to transfer this pension into a DC, then you need a pension transfer specialist. I am personally one of those. We as a firm, we're registered, we have those permissions. So again, we can help with that. Some people want to come out of the DB schemes. Moving over to DC schemes, the other type of pensions that you're going to have in the UK, think of them as sort of a general investment account. So it's in your name, it's invested, and hopefully, you know, your employer puts money in, you put money in for 20 odd years, and it's all invested, and hopefully it keeps growing. You have a big pot of money at the end of the day. The issue with defined contribution pensions is if the markets fall, then your pension's going to fall. So you're constantly on the seesaw of the markets. So it is investment related completely. These aren't guaranteed, they aren't bulletproof. You're on your own, so to speak. And it's just the same, probably all of you out there have got a 401k or an IRA. That's a DC. A 401k and an IRA, they are classified as a DC, defined contribution type plan. They are different to the UK, but theoretically, that's how they work. So those are the two main types of pensions in the United Kingdom. Again, you can get, I have simplified, you can get hybrids, which is a mixture of both of them. If you ever want to sort of move those, you do need a pension transfer specialist. And this is certainly where we can sort of help out. UK pension providers, defined contribution. Sorry about that, everybody. I think we lost connection there.
Yeah. So if you'd like to, yeah, if you'd like to go back to your presentation, I advise people that we'd lost you and we're trying to get you back. So hopefully we can continue from there. Okay.
Okay. All right. So, sorry, I'll get back. All right, terribly sorry about that, everybody. Another issue with pensions is if you go back to the UK, we've got a similar issue. If you go back to the UK, you may have a 401k or an IRA. A 401k, through experience, we see that a 401k providers typically will allow you to keep the scheme most of the time, but it's always worth, before you go back to the UK, if you're ever planning on doing that, I know a lot of people don't plan on doing it, but at some point they may consider it, think about these points before you do it. If you call your 401k provider and say, look, I'm going to go back to the UK permanently, are you okay? I won't have a USA address and I may not have a US bank account, checking account. They may ask you to leave. Most should allow you to stay, and they'll basically try and find a way to make a payment to you, because the US banks, when you leave your US address, typically won't want you to to maintain that relationship with you. There's another problem. So when you leave the United States, your checking accounts, investment accounts, typically you close them all down, you sell your property, you move back to England, and after sort of 4 or 5 years, the US bank can get in touch with you and say, hey, you're not living in America anymore, can you please close your account? So it's a knock-on effect. So obviously if they're closing the account and then the 401k provider says, well, hey, where are we going to make this payment? We're not wiring the money to England. We'll put it in a US checking account. So it's like a domino effect. So the first thing I always suggest to people is, look, if you're considering going back to the United Kingdom after many years in the United States, check with the US bank account providers and say, look, if I go back to the UK, can you keep this open? They may do it, and they may charge you a monthly fee, maybe $12 or something like that. If they don't, then there's a few tips that we have that you can potentially open another account before you leave. Places like credit unions can be useful because they're under sort of different codes, if you like, banking codes. Again, if you speak to the 401k people, they may not mind. They may wire the money to the United Kingdom. You'll probably have to sign a waiver to say, look, we're going to be sending you US dollars to inform you, the UK bank, that I'm going to be having a monthly payment in dollars, so automatically convert to sterling. Now, obviously, you're going to have to suffer foreign exchange rate, but at least you won't get kicked out. It's a little bit different for IRA providers. IRA providers, because it's more of a personal pension rather than a company pension, we found many IRA providers, as soon as you leave the United States and do not have a US address, they don't want your business. You could have a $500,000 IRA, but they just don't want the business. So it took us many years. We've actually got a solution, but it took us many years to get this solution, where we found an IRA provider in the United States that will accept US citizens abroad and or dual citizens abroad. So if you go back to England, you've got a 401k or an IRA, if they're kicking you out, we have a solution. We actually have two that we set up. Like I say, the IRA providers they're more commonly known to do this. So beforehand, you can get in touch with us. We've got a solution, and hopefully we can sort you out and help you out. So again, obviously I'm here, I'm contactable, and if you want to, the UK pension and the US pension rulings are far more complicated. I've just given you a brief sort of overview of the sort of problems that you may face. Should you want to talk about that, you can get in touch with us and we can give you a bespoke, individualized plan, because obviously everybody's circumstances are completely different. So, final bit about pensions I wanted to just touch on. It's quite a common question. British state pension, UK state. Typically, you are allowed this. There's a piece of legislation, you can Google this, it's called the Totalisation Agreement, for the Z. That agreement is between the United States and the United Kingdom, but there are certain caveats. So the minimum amount of years national insurance contributions you must have done in the UK is 10 years. If you haven't done 10 years, then you're likely not to get any British state pension. You can get the US Social Security pension and the British state pension at the same time. Excuse me, but again, there's a certain issue there. It's called the windfall elimination provision. It gets a bit complicated, which means they can discount they can discount your US Social Security a little bit because you're taking a foreign government pension income as well. So you can get both of them, but you may be affected by what's known as WEP, windfall elimination provision. Again, we can help guide you through all of that. And also the British state pension, if you've done less than 10 years but more than 3, you can top it up. Or indeed, if you're short of the 35 years, which is the full national insurance record, you may have 20 years, but you can actually top that up. Whilst you're living in America, you can still top that up. And again, that gets a bit more complicated. Could you be in class 2 or class 3? So, hey, Mark, how much does it cost me to buy one extra year? It depends which category you fall in. If you fall into one of the categories, obviously class 2, it's about £170 to buy 1 year. That's pretty good value for money, right? But if you fall into class 3, then the British government will ask you, well, £700 a year to buy one national insurance year credit. So it can get quite expensive. I would always suggest going to ukstatepension.gov. You can just basically get your own national insurance record online and see what your record is. There's another little caveat, a bit of a strange anomaly. You may have worked in England for 20 years and think, well, I've got 20 years worth of credits, Mark. Not necessarily, because if your company was known as, if they contracted out of the second state pension, it's complicated legislation, but it's called contracted out, then you won't necessarily have 20 years. You may have 15. So it's always advisable to go online and get an actual official record, and then you know exactly sort of how many years you've got. And the way it works with British state pension is pro rata. So all you do, if you've got 20 years, you just do 20 divided by 35 times £9,500, because that is the current maximum of the British state pension, £9,500 per person if you've done 35 years. Anything less is prorated. I understand that the UK state pension isn't as impressive as the US Social Security. However, you've got the other argument that we've got the NHS and so on and so forth. If you are affected by windfall elimination provision, if you read the stuff online on Google, it will be a bit scary for you. You'll think that they can sort of reduce your US Social Security by up to 50%. Don't be too concerned about that. I've run many wet calculations for clients. It's never close to the 50%. I mean, technically they could stop 50% of your US Social Security. People think it's dollar for dollar. So if you're getting £10,000 from the British state pension and you're getting $20,000, they automatically think they'll just take £10,000 off your US Social Security. It doesn't work like that. It's a complicated formula. So it's not dollar for dollar. And you'll tend to find that if you do top up your national insurance credits, it may well be worth it. But again, this is where we can analyse and review it on your behalf and help you out with that. Now, just to run through a quick checklist, just to sort of see where we are with what sort of assets you guys may have from this list, because if you do, then obviously you may fall foul of these issues, or you may want help and advice and assistance. So, as we've covered, if you've got a UK pension, you've obviously all these are possible complex, situations or issues for you. If you've got a UK pension, you may have an international pension, like a QROPS. QROPS stands for a Qualifying Recognised Overseas Pension Scheme. They're now called ROPS, so they've dropped the Q. An investment portfolio, maybe in the UK. You may have overseas funds, not necessarily in the UK, in another jurisdiction, that's not in the US or UK. Again, that creates additional headaches. You may have a US pension or pensions. And if you return to the UK, again, this is possible issues that I think we can help you with. Overseas property, probably in the UK, we can assist you with that as well for sort of planning purposes. You may just have some cash in the UK. As we know, the foreign exchange rate isn't great. I don't think it's great at the minute, switching sterling to dollars. So you may want to just keep the cash in the United Kingdom, but you want to invest it. Because as we know, interest rates are all-time low. So sticking it with the bank account at Barclays or Lloyds, you're not going to get much. But if you say, well, Mark, I want to invest this and get some returns, but I don't want to bring the money to the United States because the currency exchange, then we do have compliant vehicles that you can use. And then finally, this is quite a new service we're offering. It's a foreign currency exchange service. I believe it's very, very new, but I believe you don't have to sign up for Alexander Beard. It's actually, we've partnered with a firm where you can use them sort of outside of us, if you like. But again, we can offer that service internally too. So I hope that this has been useful for you. The final slide, I sort of want to cover off, and obviously we'll move to questions afterwards, is this final slide here is if you are going to speak to a financial advisor and you have assets in both jurisdictions, I would highly recommend speaking to a firm that is registered and regulated in both jurisdictions, simply because they're going to know what they're talking about. So the way you can do that, you can check, as you can see from the slide, you can always check the FCA, Financial Conduct Authority. They have a register of the companies that are listed there. They uphold very high standards in the regulatory world. In fact, they're probably one of the most well-respected regulators in the world, Financial Conduct Authority. You can also check in the United States. Again, there's a link there, and you can check if the firm is registered and regulated there. The usefulness of having a company that's registered and regulated in both jurisdictions is having also an advisor that's registered and regulated in both jurisdictions. And also bear in mind how long have they been in the industry. If somebody's been doing it for 12 months or so, are they going to give you holistic advice? Are they going to know all the tiny little strange caveats that somebody that's been doing it for a year or two might not notice? So it's always worth sort of bearing that in mind, people's experience, because it does go a long way, experience. Well, I hope you've enjoyed the presentation. Like I say, it was a little bit brief. There's far more detail that we can assist you with. If you want any help with any of the matters that we've covered off, then please do get in touch with us. And thank you very much. Over to you, Nigel.
Okay, well, thank you very much, Mark. Just a couple of questions we've got in. One here, I think you partially answered, but can I still get my UK state pensions if I retire to the USA? And if so, will it continue to increase with inflation as it, along with those who have stayed?
Question. Very good question. Very interesting, this one, Nigel. Yes, it will increase with inflation. Just a bit of backstory. You may have seen online in Canada, Australia, and New Zealand, British expats are very, very annoyed, which is quite rightly, that the British state pension doesn't increase. Now, the Brits in the United States do get the increases. So it will keep increasing with inflation. But this is where you've possibly seen a lot of noise online or in the daily press, that if you're in Australia, New Zealand, or Canada, for some strange anomalous reason, the British government just won't increase it. So it's gradually reducing in value. So yes, you're entitled to it. Like I say, as long as you've done 10 years or more, and yes, it will increase year on year.
Yeah. Yes, I live in Spain, and obviously Brexit is the gift that keeps on giving. And one of the rumours is that they may apply the same rules in the EU. As I understand it, that is not yet any sort of sense of policy or whatever. But yes, it seems very anomalous the way that they treat it around the world. Thanks very much. The other question here, I'm about to move to the States. I have a UK buy-to-let property. Am I okay to hold on to it, or do I need to sell it? Is it beneficial?
That's a tricky one. Buy-to-let property. It's a tricky question. It really depends if you're on sort of a temporary visa or you're thinking, I'm going to move to America permanently. So again, that's more of an emotional decision for clients. I get this quite regularly. If you think you go to America, you may not want to stay. So buy-to-let, effectively, there's no problem, no issue with it. The income will just be treated as rental income. Simple as that. You just add it to your US income. Job done. But to sell it, if you think, well, I might not stay in the United States, then you've possibly lost capital appreciation of that buy-to-let. Because we know the property market's quite buoyant in the UK. Obviously, they can go down as well as up or plateau. But until you're sort of settled or experienced life in America more, I would suggest, I mean, it's very hard. I don't want to give advice just over the phone like this or over the presentation, but I think it's very hard for me to sort of say, oh, yeah, just sell it. Because you may go to America, you've lost out on capital appreciation, and two years later, you're back in the UK. So it's really more of, I think, go out to the United States and see if you really enjoy it. At that point, then you can make a decision to sort of sell. I don't think sell it now. I think experience the life first, personally.
I have a personal experience here, if you like, not on a buy-to-let property, but on my main home for various reasons. When I was living in California and expecting to stay there long term, I sold my UK property, bought a property in the States. The property in the States I made a nice profit on when things cut short, but sadly not as much as the UK market had gone up in the meantime.
And this it's a bit of a gamble, isn't it? I mean, I've lived in America for about 4 or 5 years. I've lived abroad for 20 plus years. When I used to be an offshore banker, but I never thought I'd sort of leave, but you never know, you know, you never know.
Okay, another one here is I have ISAs and premium bonds. Are they still tax-free if I'm in America?
Good question. No, sorry. So this is again very regular question. A lot of people back in my day, it used to be called PEPs and TESAs, personal equity plans, and tax efficient super saver account or something like that. But now they're all called ISAs. And in the premium bond sort of situation is now they're taxable if it's a stocks and shares ISA. If you have a cash ISA, you may be getting interest on it. That is not classified as a PFIC, passive foreign investment company. You know, I was talking about it earlier. But a stocks and shares ISA is toxic tax-wise. What I say by that is you're still allowed to own it, but you're under PFIC rulings, which means you're looking at quite a big tax bill on the gains you've made on that ISA. Of course, if you return to England and drop citizenship, hypothetically, or your green card status ceases, then you sell the stocks and shares ISA, you don't have to worry about PFIC. If you maintain your US connection and you access the ISA, then you're talking PFIC tax charge. Yeah, so it's quite messy, the stocks and shares ISA.
Okay, there's one final question here. I think this is about Alexander Beard yourself. Are you able to give tax advice?
Good one. It's quite a strange anomaly in the United States for Brits in America, because technically you're US connected persons. The US Investment Advisor Act in the United States, 1940, they don't actually allow financial advisors to give tax advice, I'm afraid. So we do partner with several firms. We don't get any remuneration. We just like to partner with firms that can offer US, UK tax advice. So we have connections in that space. We only deal with tax advisors that are registered and regulated in both the United States and United Kingdom, and they know the double tax treaty very, very well. So we have partnered with a couple of firms that we can always pass you over to, because we know that the tax issues can get very complicated. We can give generic overviews of the sort of tax situation you may be in, like I've just been discussing today. If you say, Mark, I want actual tax advice, here's my tax returns, I'd say I have to pass you over to X, and then you just deal with them. But these guys are good. They know the US, UK tax stuff like the back of their hands.
Okay. Okay, well, thanks very much, Mark. I think we'll draw to a close there. Thank you very much. And then thank you everybody for joining us today. Before I go, I'd just like to emphasize that we're here to help you with getting the best out of your life abroad. And if we can help in any way, then do not hesitate to get in touch with us. If we don't know the answer, we'll find somebody from our network that does, but not just on the financial side, but on all aspects of living abroad. And you can contact us, as I say, on expats@expatnetwork.com. So goodbye, everybody. Thank you, Mark. Goodbye.
Thank you, everybody. Bye-bye.